In this video, we are going to look at fixed indexed annuity. A fixed indexed annuity is an insurance contract that provides clients with income in retirement. It provides principal protection in a down market and an opportunity for growth. It gives you more growth potential than a fixed annuity along with less risk and less potential return than a variable annuity. The money you place into your fixed indexed annuity and any earnings credited to you will not be lost due to a negative market. Some fixed indexed annuities offer optional riders such as living benefit riders for guaranteed lifetime income or enhanced death benefits to aid with legacy planning. Your money can grow based on the performance of an index or indices. The value of a fixed index annuity grows tax deferred, which means you won't pay any taxes on any growth until you make a surrender. There are tax penalties for surrenders before age 59 and a half, however. Some things you should be made aware of before creating a fixed index annuity account. If your clients are above 59 and a half years old, their tax-deferred status enables them to take advantage of compound growth. The original deposit will not decline if the index performs negatively. Please keep in mind, though, that all guarantees are subject to the claims-paying ability of the issuing insurance company. Cash values and principal amounts also may be affected by surrenders during the surrender period. A rider is often available for an additional cost to guarantee set payments regardless of how long you live. Or they can get lifetime income through annuitization at no additional cost. At the end of each bucket term or segment, earnings are credited if the index performance has been positive. Earnings can, however, be limited by the policy's spread or cap rates. Some carriers may offer a feature that allows clients to take advantage of index highs during a segment. Most companies offer spousal continuation only upon the first spouse's death and don't pay a death benefit out until the second spouse passes. However, some carriers do offer a joint option that may cover the death of either spouse upon the first passing. Growth potential can be achieved through the performance of the index or a fixed interest rate earned on the fixed account, or a combination of the two. It's also important to note that a fixed indexed annuity is not an actual investment in an index. It's only based on the underlying index performance. You can pass assets to beneficiaries and avoid costly probate. Optional riders, available for an additional cost, can enhance the amount your beneficiaries may receive. Here are some fixed index annuity-related potential drawbacks. With this type of annuity, gains can be limited by elements such as participation rates, caps, and interest rates. Most indexed annuities apply a cap to the annual earnings potential. For example, a particular product might limit the growth to 7%, even if the underlying index earns more. Participation rates. The participation rate is how much of an index increase you will receive. The higher the participation rate, the more of an index performance your clients will receive. For example, a product may offer a 70% participation rate, which means if the underlying index returns 10%, the client would only receive 7%. Clients need to hold onto a fixed indexed annuity for several years to enjoy its full advantage. The surrender period is typically 8 to 12 years, and sometimes longer. The money put into a fixed index annuity account is not as accessible as money that has been deposited in a savings account. If you need to pull money out of a fixed index annuity soon after you sign the contract, there will be a fee called a surrender charge. It varies from annuity to annuity, but it can be in the range of 9 to 12% of their principal. Also, you may lose some or all of the index-linked interest that has already been accumulated on the portion they withdraw. However, most fixed index annuities allow 10% annual withdrawals with no penalty. There is a 10% IRS penalty on withdrawals before the age of 59 and a half. Make sure that you understand the IRS rules governing annuity taxation and access. Possible fees may include mortality expenses M&E, rider fees, administration costs, and surrender charges.